So, thank you for asking me to talk today. I'm going to talk about some observations and some lessons from the financial crisis we've just been through. Now, among the most important lessons coming out of this crisis that started in the summer of 2007, possibly the most important ones, revolve around how complex the global financial system is, how quickly confidence in that system can deteriorate, and how difficult it is to come up with simple and robust solutions to stabilize the system in real time. Now, my remarks today will break the progression of the crisis into 4 distinct phases for you. In doing so, my intention is to highlight some of the actions taken by the Federal Reserve to manage the crisis and to offer what, at least in retrospect, seem to be clear lessons on how to promote financial stability outside the heat of the crisis. So the 4 distinct phases of the crisis are going to be as follows. First, we're going to look at the initial disruption in money markets in the summer of 2007. I'm going to call this "What are these securities worth?" phase. Then we're going to move on to March 2008, the abrupt takeover of Bear Stearns by JP Morgan Chase. We're going to think of that as the unusual and exigent phase. Then we're going to move on to September 2008 and the 30 days that followed the bankruptcy of Lehman Brothers. I'm going to call that the panic phase for you. And then we're going to finish by looking at the period from mid-November 2008 to early May 2009. I'm going to think of that as the viability of large U.S. banking organizations phase. Now, one consistent theme that emerges across all these phases is that central banks, like the Fed, must have the ability to respond quickly and flexibly in a crisis situation. This ability is crucial in preventing the emergence of an adverse feedback loop between instability in the financial system and weaknesses in the real economy. Another theme that emerged as these phases played out, however, was an ability to move with speed and flexibility comes with the challenge of ensuring that accountability and transparency keep pace with the actions being taken. The need for accountability and transparency is especially true when the central bank actions are being used to innovatively fill holes in a regulatory and legal framework that has not kept pace with the evolution of the financial system. So let's move to phase 1. What are these securities worth? On August 9, 2007, the large French bank, BNP Paribas, announced that it suspended activity in 3 of its funds so it could more precisely assess their value. They stated the problem as follows. So I'm just going to quote from their press release. The complete evaporation of liquidity in certain market segments of the U.S. securitization market has made it impossible to value certain assets fairly, regardless of their quality or credit rating. Central banks immediately responded to the evaporation of liquidity in the standard manner. For example, the Fed issued a statement on August 10th, the next day, indicating that it was providing liquidity for the orderly functioning of markets. And in the statement, the Fed emphasized, as always, the discount window is available as a source of funding. 1 week later, it reinforced the statement with a 50 basis point cut in the discount rate and the addition of a 30-day term loan to complement the standard overnight discount window loan. Now, at that time, the discount window of Federal Reserve banks were only open to depository institutions. So standard monetary economic theory and previous experience was consistent with the notion that depository institutions could act as intermediaries to pass liquidity through to the rest of the financial system. Indeed, in many early episodes, think back to 1987 and other events, the mere fact that backstop liquidity was present had been sufficient to calm financial markets. Circumstances proved very different in this episode. For one, the rise of the shadow banking system meant that a preponderance of financial intermediation in the United States was being performed by non-depository institutions that funded themselves in wholesale rather than retail markets. Further, traditional discount window loans have always been vulnerable to stigma. That is, if a bank borrows from the central bank, it runs the risk that markets and counterparties may infer that it is closer to insolvency than was previously thought. The potential for stigma to damage the effectiveness of this crucial backstop facility explains why the identity of discount window borrowers is not disclosed by the Federal Reserve. Indeed, we saw early in the crisis that many depository institutions proved unwilling to take the risk of possible stigma, the result of which was an increasingly severe impairment to the flow of liquidity to the rest of the financial system. Now, in late August 2007, a new facility was designed to help overcome stigma through the use of an auction mechanism. But as the market calmed in September to late October, the facility was shelved. It was ultimately introduced on December 12, 2007, as a term auction facility, and that was in a coordinated announcement with other central banks across the world. So this first phase has some obvious lessons for financial stability. Financial products that are new and complex should be treated with caution. Regulators, credit rating agencies, and market participants all have limited ability to evaluate the properties of such complex products at their inception. For example, the fact that credit rating agencies bestowed their highest ratings on certain securities prior to the crisis meant that many investors assumed that the securities were informationally insensitive. What was subsequently learned, however, was that instead of being robust to economic developments, the complex structure of these securities had merely served to concentrate the systemic tail risk in them. Now, new financial products are often associated with the extension of primary credit to underserved sectors of the economy. This extension of credit to previously underserved often produces abuses or outright fraud, many of which can be masked by the newness and complexity of the products. In many respects, these are old lessons that we should have learned already from what occurred to run up of previous episodes of financial crisis. However, the remarkable stability of the US economy from the mid-1980s to 2007 unfortunately produced what amounted to a collective amnesia with regard to these earlier learned lessons. For example, most macroeconomists, like myself, have become convinced that the widening and deepening of the financial system over the previous 20 years, driven by the deregulation of markets and given additional impetus by the return to low and stable inflation, was an important source for this economic stability. Now, this is not to say there was no one pointing out the risks of low-risk premiums and the rapid growth of structured investment products. But many economists, analysts, and commentators have reached the blissful state of mind that it was different this time. In this context, it's useful to recall an unease articulated by former Federal Reserve Board Chairman Alan Greenspan back in 1996. I'm just going to quote this famous phrase from it. Clearly, sustained low inflation implies less uncertainty about the future, and lower risk premiums imply higher prices of stocks and other earning assets. But how do we know when irrational exuberance has unduly escalated asset values? This uncertainty about the link between fundamentals and current asset valuations is crucial to interpreting this initial phase of the crisis. For example, one relatively benign interpretation of what was playing out was that the financial system was experiencing a liquidity problem driven by a maturity mismatch in the shadow banking system. The liquidity problem was unusually severe because of the collapse of the shadow banking system and the resulting pressures that collapse placed on the balance sheets and liquidity positions of the traditional banks. Nonetheless, the situation was fundamentally viewed as a liquidity problem rather than a solvency problem, meaning that any potential credit losses were likely to be small and easily absorbed. An alternative, darker view was the global financial system was overexposed to land prices in the United States through the home sale and mortgage refinance boom that had taken place in the last 4 years. This darker view was given less credence, in part because of the magnitude of the fall in US nominal house prices necessary to produce a situation where the losses could not be easily absorbed was viewed by many as implausibly large. At that time, the conventional view was that by standard regulatory and accounting measures, most US financial institutions had more than ample capital against the risks they faced. Furthermore, institutions were raising new capital to fill the reduction in accounting capital being produced by the write-downs associated with subprime-related assets. So let's move to phase two, unusual and exigent. So we're going to move from December about 4 months now. On Tuesday, March 11th, 2008, the Federal Reserve announced an expansion of its standard securities lending program for primary dealers to a facility that accepted a wider range of collateral and lent at term longer than overnight. This new facility, known as the Term Securities Lending Facility, or TSLF, was designed to help ease the ongoing erosion of liquidity conditions in funding markets that was occurring despite the 2 large cuts in the Fed funds target in January 2008. 2 days after the Federal Reserve announced the TSLF, Bear Stearns, the 5th largest investment bank in the US, ran out of cash to meet its obligations for the next day. Over this ensuing three days, the Fed, the SEC, and the US Treasury facilitated the takeover of Bear Stearns by JP Morgan Chase. The Federal Reserve used a lender of last resort authority it had been granted in the 1930s under Section 13.3 of the Federal Reserve Act to facilitate the transaction. Further, on that Sunday, March 16th, the Federal Reserve announced the introduction of the Primary Dealer Credit Facility, an emergency extension of the standard discount window facilities to primary dealers. 2 days later, on March 18th, the FOMC cut the Fed funds target by 75 basis points, bringing the total decrease in the target since the start of the crisis to 300 basis points. At that time, many saw this as the peak of the crisis and assumed that the weaknesses of the financial and regulatory system would be fixed as the crisis subsided. At this point, it's worth spending a moment to explain a little more detail on the basic elements of Section 13.3 of the Federal Reserve Act, a provision that had only previously been used for relatively small loans in the 1930s. Section 13.3 allows the Federal Reserve Bank to lend to any individual, partnership, or corporation under the authority of a supermajority of the Federal Reserve Board in unusual and exigent circumstances. But there's some conditions that go along with this. The first one is it can only do this if adequate credit accommodations are not available from other banking institutions. And, most importantly, if the Federal Reserve Bank is secured to its satisfaction. This last condition effectively represents the dividing line between lender of last resort actions on the one hand and capital injections or some other forms of unsecured lending on the other hand. It's a critically important dividing line the Federal Reserve carefully respected in all of its actions over the course of the crisis. One lesson that emerges from this and later phases of the crisis is that while the Federal Reserve's authority and accountability for 13.3 actions taken in March 2008 and throughout the crisis were well established under the Federal Reserve Act, what was crucially lacking was a public transparency regime that would allow the public to immediately track and understand the details of these extraordinary actions. The complexity of creating a robust, responsible, and safe transparency regime in the midst of rapid change and extreme market fragility notwithstanding, the fact that public transparency of a central bank might lag the actions being taken by the central bank creates its own set of risks. In fact, the importance of transparency, keeping pace with actions, was the main theme of Greenspan's speech in 1996 when he talked, just as an aside, about irrational exuberance. And I want to quote him again now, and this is what he said back then. If we are to maintain the confidence of the American people, he's talking about the Fed, it is vitally important that accepting the certain areas where premature release of information could frustrate our legislative mission, the Fed must be as transparent as any agency of government. And it cannot be acceptable in a democratic society that a group of unelected individuals are vested with important responsibilities without being open to full public scrutiny and accountability. Now, as I just mentioned, establishing an appropriate and responsible transparency regime for emergency lending in the midst of a severe crisis is an especially challenging task. With sufficient time to assess the maximum amount of information that could be released without frustrating its mission, the Federal Reserve now discloses extremely detailed information to the public about all of its facilities. In the web version of my remarks today, I've put a link up so you can go look at those pages. There's numerous pages with great detail there. However, the fact that this kind of detailed information was not instantly available gave rise to a substantial public criticism. Another lesson that emerged strongly in this phase of the crisis was the need for adding to the regulatory toolkit a robust and efficient method for resolving complex financial institutions without imperiling the safety of the broader system. In the case of Bear Stearns, the presence of a willing acquirer presented the opportunity for an assisted transaction that effectively amounted to an ad hoc resolution mechanism for the failing firm. One sense in which the solution was ad hoc was that policymakers could not be sure that a willing acquirer would be found in the case of distress in the future. But another, perhaps more important sense, is that the rules of the game were not clearly established in advance. In this context, I think it's worth noting the United States had led the world with the Federal Deposit Insurance Corporation Improvement Act in 1991. That established a state-of-the-art resolution regime for depository institutions to avoid panics and runs associated with the risk of insolvency, and made sure that they gave the maximum protection to taxpayers. However, this regime did not address how to efficiently resolve holding companies that included a depository institution, investment banks or other financial institutions that were tightly and very intricately woven into the global financial system. Perhaps because many thought that March 2008 was the height of the crisis, the overwhelming importance of the lesson coming out of the Bear Stearns episode did not translate into this gap in our regulatory frameworks being addressed with sufficient urgency. As I will discuss momentarily, this gap re-emerged as a main accelerant of the crisis with the collapse of Lehman Brothers in September of the same year. Although it's worth acknowledging that Congress did approve legislation setting up a special contingent resolution process for the GSEs in the summer of 2008. Now, a final lesson from this phase of the crisis was there's a critical need for policymakers to question the validity of the assumptions that they often take for granted in assessing the risks of the financial system. For example, most macroeconomic models do not have an explicit banking sector. Thus, in simulations of the effects of large house price declines, the main channel of propagation is an indirect one through a wealth effect on consumption. As house prices continue to decline at unprecedented rates, many analysts started to reconsider the adequacy of what had previously been considered ample capital in the US banking system, and thus the extent to which capital would be a firebreak against a significantly sharper contraction. If this firebreak was insufficient, or perceived to be insufficient, then these analysts correctly anticipated that a vicious adverse feedback loop would take hold. Declines in economic activity would make financial institutions reluctant to lend in order to conserve capital for possible credit losses. The decline in lending would further reduce economic activity, and so on. This type of non-linearity had not been part of the pre-crisis evaluation of the risk of large house price declines. But by the spring of 2008, it was becoming a central concern. I'm now going to move to the panic phase. The bankruptcy of Lehman Brothers on September 15, 2008, precipitated a run on the global financial system of a previously unimaginable scale. The Federal Reserve was immediately confronted with a huge, unanticipated call on its lender of last resort power as a result of a substantial liquidity problem at one of the world's largest insurance companies, AIG. The Federal Reserve's decision on September 16th to lend to AIG was a classic lender of last resort action, of exactly the type envisioned by the statutory power given in 13.3. However, given the speed of developments that week, there's been considerable confusion and misperceptions over the validity of the initial decision to lend to AIG. Again, on the web, I put up a link where you can see some testimony where we explained in detail what was going on that week. It was unknown on September 16th just how quickly the panic would spread and how harmful it would be to the real economy. By the next evening, September 17th, it was already obvious the panic had spread to prime money market mutual funds with devastating effects. These funds provide short-term financing to numerous firms and institutions through the commercial paper market. A myriad of other breakdowns were occurring as trust vanished from the global financial system. Against this background, the request for the $700 billion TARP appropriation was made the next day. Now, in the short time it took Congress to pass the TARP appropriation, the panic continued to spread. On September 25th, Washington Mutual, the sixth largest depository institution, was resolved by the FDIC. And just days later, Wachovia, the fourth largest bank holding company, encountered severe funding difficulties and was eventually taken over by Wells Fargo. As with the need to place the two largest GSEs into conservatorship that had happened just the week before, it became apparent that much of the supposed ample capital in the U.S. financial system was not an effective bulwark against insolvency or, perhaps more importantly, the perception of possible insolvency. The latter possibility, whether true or not at its inception, can ultimately become a self-fulfilling prophecy if it results in a run on the financial system. Now, there are three broad forms of policy responses available to arrest the self-fulfilling prophecy dynamics that can take hold during a run on the financial system. The first are lender of last resort actions to assist the economy in adjusting to the severe funding strains produced by the run. The second are guarantees, the issue to reassure existing liability holders, keep them in place. The third are capital injections to strengthen the actual and therefore perceived solvency of financial institutions. By early October 2008, it was apparent that a substantial escalation on all three fronts was required to give the financial system what was essentially a timeout in order to halt the self-fulfilling prophecy dynamics. Now, it's useful to consider the analogy of timeouts that parents give to their children when they are misbehaving. While the analogy is not appropriate in terms of the punishment aspect of timeouts for kids, there are a number of similar problems in the establishment of a robust timeout strategy. First, how to define the boundaries associated with the timeout. In the case of arresting a run on the financial system, who does and who does not have access to lender of last resort, guarantees, and capital injections? Next, can the parent or the government credibly announce and then efficiently operate the timeout? Finally, as all parents are acutely aware, how does one build an appropriate exit strategy from that timeout? In the second week of October, there was no room for any error in any of these dimensions. But instead of one unruly child and the parent playing out a long-standing battle, a diverse set of policymakers were confronting a wide range of financial institutions with no experience with timeouts on either side. Further, full participation by systemically important firms was crucial due to the interconnectedness of the financial system. The solution for the efficient operation of the timeout was on the fly to combine the power of the FDIC to provide guarantees to liability holders of banks under the systemic risk exception embedded in the FDIC Improvement Act with two other authorities. The first was the U.S. Treasury's new ability to provide capital from those new TARP funds. And the second was the Federal Reserve's authority in unusual and exigent circumstances to flood the financial system with as much liquidity as it needed. In the latter case, the appropriate measure of the escalation is not the actual amount of liquidity that was drawn from the Federal Reserve, but the commitment to supply whatever was needed. This commitment was captured succinctly in the minutes of the October 2008 FOMC meeting. I'm just going to quote the last section of what's called the policy paragraph. The committee agreed that it would take whatever steps were necessary to support the recovery of the economy. Of course, parents usually have the capacity to perform on a timeout if the initial announcement directs the child in the appropriate direction. In this case, the initial announcement had to direct thousands of institutions in the appropriate direction on equal terms, including a majority that had not been misbehaving in the run-up to the crisis. In particular, stronger institutions might view their agreement to use the guarantees and issue equity to the U.S. Treasury as stigmatizing and make them more vulnerable to runs. The solution was to obtain agreement from 9 systemically important institutions to participate at the start of the timeout on the same terms available to thousands of other eligible financial institutions. The timeout announced on October 14, 2008, was a critical success in terms of stopping the run on the global financial system. But it could not and did not address all the aspects of the crisis. The global propagation of the financial shock had already triggered an economic slowdown at least as abrupt as any during the Great Depression period. The underlying question was now how strong the adverse feedback loop would be between the rapidly deteriorating real economy and the conditions of the banking system. One clear lesson from this phase was a need for formal coordination among the diverse authorities in the US in establishing and maintaining financial stability. Another lesson that emerged was that some forms of regulatory and accounting capital were very weak defenses against the fear of insolvency. Both lessons were informing the ongoing work of regulatory reform and of enhancing the resilience of the financial system through stronger capital and liquidity requirements. So let's turn to phase 4. It's about the viability of large US banking organizations. This phase starts in about mid-November 2008, as both the stock market and credit default swaps suggested increasing doubts on the part of market participants that large US financial institutions had sufficient capital to withstand the losses that might arise from further deterioration in the real economy. For example, on the weekend before Thanksgiving, the FDIC, Federal Reserve, and US Treasury, in response to intense market pressures, came up with a support package for Citigroup, followed in January 2009 with a similar package for Bank of America. From the public's perspective, these interventions were becoming harder to understand. From a policymaker's perspective, there seemed no end in sight. In the market's eyes, many banking organizations have become uninvestable. Thus, as part of the financial stability plan of the new administration, a comprehensive and forward-looking assessment of the capital needs of 19 bank holding companies with more than $100 billion in assets was set in motion. Now, meanwhile, the Federal Reserve was making good on that commitment they made in October 2008. They were reacting by cutting the Fed funds rate so as close as they could to zero, the zero bound. They were starting large-scale asset purchases of agency debt and mortgage-backed securities and treasuries in March 2009, and introducing a facility to reinvigorate the securitization market. But I'm going to focus on what's the so-called stress test. Now, the objective of the formal name of it was the Supervisory Capital Assessment Program, was not to assess the solvency of the 19 companies. Instead, the objective was to assess their capital needs under a deeper and longer recession than was the consensus in early 2009, and then require them to meet these capital needs in the very near term, before the adverse scenario developed. One important rationale for the program was the presence of the additional capital would make the adverse scenario less likely. It would cut the adverse feedback loop out. The credibility of this strategy was dependent on the availability of the U.S. Treasury's Capital Assistance Program to provide capital if the private market was unable to do so. Moreover, a brave decision was made to be transparent about the procedures the supervisors were using in their assessment and to pre-commit to disclose detailed results. In addition, the main measure of capital needs will be in terms of common equity, rather than the preferred equity that was used in the U.S. Treasury's Capital Purchase Program. The assessment process took just under 3 months to complete. It involved many innovations in the supervisory process that will continue to influence the approach to the supervision of large, complex financial institutions in the future. The results of the assessment were striking. Under the more adverse scenario of a longer and deeper recession, the 2-year loss rates, on average across the 19 banks, were projected to be as high as any experienced during the Great Depression. Further, this average hid an incredible amount of heterogeneity across both banks and asset classes. Banks' ability to absorb such projected losses would depend on their ability to generate revenue in the future, as well as on their current capital cushion. The assessment identified a net capital need of $185 billion, based on the fourth quarter of 2008 capital positions of the firms. After taking account of capital raising actions already underway, as well as the revenue generated in the first quarter of 2009, the net need for new capital was $75 billion spread across 10 of the 19 institutions. These capital needs were for the highest quality type, common equity. Perhaps the most striking outcome of the process was that a detailed publication of the results for individual banks proved to be confidence-enhancing and served to make banks investable again. Thus, a key lesson from the SCAP process was that under certain circumstances, transparency about the methods used and a willingness to commit to disclosure of the results by public authorities can be a calming force. It is also worth noting that while the financial crisis has taught us that financial institutions need high-quality common equity capital to absorb losses, that transparency and disclosure about their potential exposures are essential, it's not given any definitive indication of how much larger the capital buffer of financial institutions need to be to assuage worries about future tail events that can drive panic. So I'm going to just make some brief conclusions now. Looking back over the run-up to the financial crisis and its initial stages, it's obvious now, with the benefit of hindsight, that short-term tactical missteps and long-term strategic miscalculations were made by both the private and public sector. Many of the long-term strategic miscalculations were related to allowing perverse incentives to build within the financial system and allowing significant gaps in the regulatory framework to persist. The financial reform proposals currently being considered by Congress are appropriately trying to ensure that such perverse incentives are removed from the financial system and exploring ways to endow regulators with an efficient resolution mechanism for systemically important financial institutions. Some of the short-term tactical missteps were the failure of bank regulators to force high-quality capital raises early enough in the crisis, and the failure of the private sector to engage in adequate liquidity contingency planning, along with regulators' failure to recognize the vulnerability of the system to erosion in liquidity conditions. But as the crisis intensified to unparalleled heights, and without an efficient resolution in place, the ability of the Federal Reserve and then other government agencies after the TARP appropriation to act with speed and flexibility was vital to stabilizing the system. Now, hindsight is much less definitive on some of the lessons about the underlying stability of the financial system. I'm going to quote Greenspan again. He has a very thoughtful review of the crisis that he wrote just a few months ago. And this is what he said. The aftermath of the Lehman crisis traced out a startlingly larger negative tail than anybody had earlier imagined. I assume with hope, more than knowledge, that this was indeed the extreme of possible financial crises that could be experienced in a market economy. So this motivates a final lesson coming out of the crisis, which is that policy making, whether it's fiscal, monetary, supervisory, or other, must always strive to be as forward-looking as possible and to be robust to the possibility that we'll experience situations tomorrow that are unimaginable today. Thank you. So I'm not going to talk about Europe directly. I think the theme of the talk I just gave you is it's crucial that the Fed and other authorities have flexibility and the ability to react quickly to any events that might happen in financial markets. And I think that what we have to think about is the Fed still has that flexibility. It put in place foreign exchange swaps just 3 weeks ago. Again, just as a backstop. So the fact that they're there should act to calm markets.
There's been some criticism of government intervention during the whole crisis. And if the Fed did react in the winter to the spring of 2008, 2009, what do you think might have happened?
If the Fed had not reacted as strongly as it did, well, it's hard to be sure. I don't think any of us want to think about how bad it would have been. I can remember in early March 2009 when auto sales came out and they were back at a level of the late 1970s in the US. At that point, there seemed no stopping for this vicious adverse feedback loop. And so it was appropriate for the Fed, as I said, to take whatever steps were necessary to promote the recovery in the economy.
And finally, there still are some challenging things that are going on in the U.S. right now. The most recent thing is the BP oil spill. Do you think that this is going to have an impact on the economy in any serious way?
I don't think I want to talk about the specifics there, but I think the closing lesson I had, that we should always be thinking ahead as policymakers, this is a great example of that.
Thank you very much.